Okay. All right. Good afternoon, guys. I'm glad to see 52 people right now on the Zoom conference today. Again, quick housekeeping item. If you're not speaking, please go on mute and turn on your cameras if you want to be seen. It'll be nice to see the faces with the cameras. And also use your real name that you use in the chat group so that we can associate who's who. Makes it easier and more personable to have this session. So a few things that people have been asking me lately is, okay, how is 2021 going to be different than 2020? Okay, so I prepared a couple of slides on that to help you guys based on, my opinion, my research, and so on. And second thing is, you guys have probably seen lately I've been trading a lot of small caps, and I feel like I kind of figured out a few formulas on how to trade these. And these small caps, as you can see, have make huge moves. Okay, I think you guys have seen OCGN, Sava, all these, the crazy moves these can make, up 200, 300%, and again, I don't recommend these stocks for everybody, but if you have the appetite and you can figure out and learn the process to identify these setups, I think, you will be handsomely rewarded. So that is what I want to go with. So a couple of these things. So just a reminder, if you're not speaking, please.
Go outside, then you're.
Or you know what? Maybe I should just do that for everybody. Okay, I have muted everybody. Okay, I think that's easier. So what I'm going to do is use a couple of slides that I prepared, like I mentioned, so that we can have a better conversation and you guys can understand the process and things like that. Okay. So I'm going to show my screen. Can you all hopefully see my screen? And just use the chat to communicate so that, if there is an issue, I know what's going on. Okay. So this is a deck that you guys have probably seen. I've used it some of my previous seminars. So I'll continue using this. What I plan to do is, basically continue updating it, adding new slides as things go on. I think that's an easy way to keep track of things. So if you see, I've highlighted about 4 topics that I want to cover today. Okay. I think that's probably pretty much what I'll be able to cover, since we want to keep this our sessions under 2 hours. I think that's the most we can do. And I want to keep it interactive. So once I cover some of the content, I'll open up and, you guys can ask me questions so that, this will be a more productive session. Okay. For those of you who have not attended any of the previous seminars, I think I've mentioned the, Trader Talk YouTube channel link. You guys can go take a look at that. We had 4 sessions in the past. I think all of them are going to be useful for you. Again, if you are a serious trader, it's very simple. You have to put the time into it. Okay. I think you guys know the old adage, right? Give a man a fish and he'll be happy for a dinner. But if you teach him how to fish, he can feed himself for the rest of his life. So that's a simple principle, I'm also going to follow here. So if you guys learn how to trade these stocks, how to, lock profits and how to identify the setups, you're going to be a lot more better off than trying to follow somebody else, because end of the day, I think that's what you want to do as well. Okay. So trading basics, tools, short selling, all this stuff, we covered in the past. So you guys can look at the past videos. So what I'll do is I'll focus on the after hour squeezers and rollovers. Okay. So that is the thing that, I wanted to focus today. That's what, triggered this seminar, because a lot of folks were, wondering how I kind of figured out OCGN would make this big move, in after hours that afternoon on Friday, the 5th of February, which was just 2 weeks ago. Okay, less than 2 weeks. So here is how it works. So first thing is, these are small, hard to borrow stocks. Okay, now if you guys don't have a hard to borrow account turned on, you definitely want to do this. Okay, Because that is how you will find out how to play these games. And I'll go over a little bit more into what hard to borrow is. So this is very much related to short trading. Okay. So the basic of stock trading is you normally, when you have a long trade, you buy low, sell high, right? That's pretty much the standard thing that everybody has known, everybody has seen or done for many years. But some of the experienced traders, you probably know that you can also buy high and sell low. I know it sounds weird, but if you are familiar with short trading, you know that's very common and simple. The simple premise is that you are selling the stock first because you think that the stock is going to go down, just like how you are buying the stock first before you think it's going to go up. Okay. So if you buy high and sell low, that's called shorting. Okay. Now, how does shorting work? Let me actually quickly review that so that you guys can, you know what? Okay. So like I said, you sell first and buy later. But how do you sell when you don't have any shares, right? So what you do is you borrow somebody's shares from your broker, whether it's TD Ameritrade, E-Trade, or whoever your broker is, and then you sell them. Okay. So that process is called borrowing. Okay. Now, hard to borrow, as the term implies, you don't have shares to borrow. Okay. These are thinly traded stocks. Okay. Low floats. When you don't have a lot of shares available, then you don't have shares available to borrow either. Right. So that is the problem. So they call them HTB. Okay. But if you can locate the shares to borrow, okay, which the broker does everything behind the scene, you don't have to worry, then you can buy them back at a lower price. Okay. So you borrow and sell, that is step one, and then you buy it back in step two. Okay. So this explains it a little bit better in terms of how it works. So the broker borrows 10 shares, okay, and gives it to the short seller. And then the short seller sells those 10 shares, okay. And once the value loses, then another short seller will come and buy them back, okay. If the short seller is you, then you basically buy it back. And then you return the shares back to the broker, and the broker returns it back to whoever they borrowed it from. Okay. So we won't go into the details of the risk and all that, because I think you all know short selling is not for amateurs, not for novices. So if you're starting out, please don't try short selling, because it is definitely a little bit more tricky, and you'll need more experience. Okay. So now coming back to hard to borrow, as I explained, if a share is hard to borrow, okay, that is one of these short squeezer setups usually. Okay. Now these shares are usually low priced. Okay. They're usually like about $5 to $10, and they've been moving up on positive news. Okay. So, COVID is obviously like a very hot area. Any biotech that says they're doing something in COVID, that's it, right? The stock runs. We know that. And that's exactly what happened with OCGN, okay, Oxygen. Now, Oxygen, for those of you who are not familiar with that news, what happened is Oxygen is a small mom and pop company of like 10 employees, okay? These are mostly, of Indian origin. They're US nationals, but of Indian origin. So they have some contacts at Bharat Biotech. Bharat Biotech is a company that created the first COVID vaccine in India, right? Which is, of course, a little controversial because they don't have a lot of studies and data, and the efficacy rate is questionable. Even the doctors in India are not really recommending the Bharat Biotech vaccine. Okay. But all those things aside, Oxygen has been very clever. They did the deal with Bharat Biotech, and they did an excellent job creating news around it, getting in the media and all that. Okay. And Oxygen was basically a dollar stock. I think it was less than $1. Okay. But then it started running up. Okay. So what happened is, so as I said, this is a small stock, small company. So it's a low float. A low float means you have few shares available to trade. Okay. It is not going to be like a Microsoft or Apple, which has billions of shares available, right? These are mega caps. Low float stocks are usually like, maybe 10, 15 million, maybe less, okay, shares available to trade, which is, not much in a market like ours. 10, 15 million shares can trade within an hour. Okay, so obviously that creates a demand. And end of the day, remember, the stock market is simply driven by supply and demand. It doesn't have anything else to do. Okay, the company can be amazing, the news can be amazing, they may have a great breakthrough and all that stuff. But if there is more demand than supply, in this case, the supply is the float, which is the number of shares, the price will go up. And the vice versa is the same. Okay, if nobody wants the shares, shareholders are dumping the shares, then the stock price will go down very quickly. Okay, and that is why the small caps, low floats are very profitable and very dangerous to trade. Okay, they're very profitable if you can get in at the right time and get out at the right time, like I mentioned. And that's what I said. I've been focusing for the last couple of months on exactly that strategy, and my trades have been much better than 2020 now. Okay, because I've been doing that. And I'm doing the same thing on shorting as well. I'm trying to short on the top, and sometimes I'll average up, but then I'll cover when it's going down, and I can make a quick 10, 15, 20%. So, just a very profitable trades. Obviously, you cannot make 10, 15, 20% by trading Apple and Facebook and, Microsoft in a day, right? That's not going to happen. So that is why the small caps are so powerful. So the third thing is, these short squeezes, I'm noticing that seeming to happen on Fridays. Okay. Why is it on Fridays? Because whenever a stock is hot to borrow, like I mentioned, the broker charges a special interest rate. Okay. That's how they make money, especially now, because it's all zero commission trading, right? So how are the traders making money? And the brokers making money? They are making money by charging heavy interest rates on these hard to borrow stocks. Okay. OCGN was actually not bad. I think OCGN borrow rate was only around 5% from what I remember. But there are some companies, some stocks that, the borrow rate is 70, 80, 90%. Okay. That is annual percentage. Okay. Not per day, obviously. So that translates to, even if it is like 90%, interest stock, in a day, you're probably, paying less than 1/3% or something. Okay. So it's not bad, but, that adds up, right? So for example, you have, I'll just throw a number. Okay. Say you have 1,000 shares. Okay. 1,000 shares. Okay. Please ignore the price on the top. Okay. I'm talking about this area. Okay. So in this example, 1,000 shares. Okay. It was around 520 or 530. Okay. $5.20, 30 cents when the stock price dropped. Okay. So if you're a short seller, if you're a short, you have the shorts, you borrow for OCGN on a Friday afternoon, 10 minutes before close. Okay. This is Central Time, by the way. So this is 3 p.m. Central, which is the market close. So about 10, 15 minutes before close, okay, the stock dropped. Okay. It dropped about 20 cents. So now if you are holding a short, okay, you feel happy that, okay, maybe you shorted here at, 550 or even 540, and now it has come down to 520 or 530. Okay. You're like, okay, good. I'm above the water now. I'm happy. It's not so bad. I can manage, I can hold it for the weekend. Okay. Now holding for the weekend, remember, there is going to be an interest. Okay. In OCGN's case, it's only 5%, which, daily rate will be probably like, 1/4%. Okay. So 1/4% on, 1,000 shares. Okay. Which is probably around $5,500 times 1/4%. So we're talking maybe about $100 per day. Okay. $100 per day interest is not so bad. Okay. But if it is a Friday, then you're like thinking, okay, what is the point of holding it for 2 more days, where I'm paying interest for nothing? Okay. So, you might want to cover, but then you're like, you know what, it's already coming down, so don't worry about it. I'll cough up the $100 a day. It's not a big deal. I will, take care of, I want to hold it because, it might go down from 5.5 or 5.3 all the way to $2 or $3. Because remember, OCGN was a $1 stock just a week or two before that. Okay. So they feel comfortable. Okay. So again, recap the setup. Okay. Typical setup, a strong action all day with heavy volume, right? Look at the volume. Okay. All big bars. Okay. I remember each bar, this is a 5-minute chart, right? This is a 5-minute chart. Each bar was like about, 200,000 shares. Okay. Now remember, this is a low float. Okay. Normally it probably shares, it probably trades 200,000 shares in a day. Now it is trading 200,000 shares in 5 minutes. Okay. So massive volume, right? So strong action, heavy volume. Okay. And remember, there was a positive news about, the COVID deal in terms of OCGN for Sava, Cassava Pharma. It was the Alzheimer's study. Okay. So just giving those examples. So what happens is, okay, weakness during the close equals, okay. So if I'm holding shorts, I'm probably thinking, okay, this stock is going to roll over soon, so I'm not going to cover. Okay. So guess what? That is a potential short trap. So the simple thing is the stock is strong the whole day, heavy volume. Okay. And a few minutes before the close, maybe 15 minutes, 30 minutes before the close, I would say definitely within the last hour of the close, the stock drops. Okay. And what does that do? That makes all the shorts complacent, saying that, okay, I'm fine. This stock is going to roll over. We're going to be fine. Okay. And that is exactly the short trap that I'm explaining here. Okay. And then as soon as the market closes during after hours, what happens is some shorts decide to cover. Okay. Why are they deciding to cover? Because they don't want to pay the interest. Especially if it's on Fridays, they want to avoid the weekend interest. Okay. And also there's always uncertainty, right? I mean, these days, you can see a stock weak and the next day morning it shot up, right? 30, 40, 50%. We've seen that for so many stocks. So if you're a short, you're worried and you're like, okay, you know what, I'll just cover. And now what does cover mean? Cover means basically you're buying the share, right? Now we're buying the shares, obviously, again, goes back to supply and demand. The demand for the shares is going up, which means the price is going to get bid up. Okay. And obviously this was a hot stock. So there are a lot of people watching this. As soon as the share starts moving even a little bit, look at how much movement OCGN made in the first 5 minutes after the close. From 3 p.m. to 3:05 p.m. Central. Okay. It moved up from say about 520. Okay. Look at the high of the bar. This is about 570, 575. Okay, it made a 50-cent move, which is like 10% in 5 minutes. Now, guess what? That is going to create a panic among the shorts. Okay, so during after hours, some shorts decide to cover and the stock moves up. And now what happens to the longs? This attracts the longs. Okay, if you're a long player, you're like, oh, wow, there's momentum in the stock. Let me play this, let me jump into this. Okay, now long players are jumping in at 520, 530, 540, 550, whatever. Okay. And guess what? Suddenly the volume starts peaking. Look at the volume. For after hours volume, it's almost as much as regular hours volume. Okay. Whenever the pre-market or after-market volume is as high as a regular volume, that shows you that the stock is being very actively traded. Okay. Because after hours, as you guys know, the volume drops to like 5 or 10% of the normal volume. But as you guys can see here, the volume is pretty much the same or even higher in some cases, as you guys can see. And this chart is, not a complete chart. I just wanted to show you guys a snapshot, and that's exactly how the longs pile on, the shorts are trying to cover, and that triggers a huge short squeeze. Okay. So look at this. From 3 p.m. to 3:30 p.m., it's only 30 minutes. The stock went up from 520 to 750. Okay, that's basically a 50% move in 30 minutes in after hours. And those of you who remember or who are trading, you probably remember this stock went up all the way to like what, $13 or something like that in after hours. It was nuts. Okay. So I bought it, I think around 5:30, and I sold it, I think around $9. So I was very happy. I almost doubled my money in, maybe like an hour. Okay. Again, like I said, you have to know exactly what the setup is. So it is not simple to identify, and it doesn't work all the time. Remember, at the end of the day, it's always a potential. Any setup is about probability, right? So when you see this pattern, all I'm saying is that the probability for a short squeeze is going to be very high. And that's usually what I mentioned in the chat. I mentioned that, hey, it's possible for an after hour squeezer. Okay. And it's end of the day, it's risk and reward, right? I'm going to buy a couple of thousand shares and see what happens. Hopefully it moves. And these days, especially in this market where you have lots of retail traders, lots of volume, lots of money, these squeezes are happening more often than ever. Okay. Another example was Sava. I think Cassava Pharma, you guys know, that also went through some massive short squeezes. Okay. At this point, I'll let you guys ask me any questions because I know it's not a very simple topic to understand. I'm sure you probably have some questions. Okay. And I'm looking at some of the questions here in the chat. So unmute yourself. I think the system should allow you. Okay. The scanner to look for stocks in short trap. Unfortunately, there is really no, built-in scanner to do these things. It's not so, cut and dry. A lot of these are basically from experience. You have to watch the hot stocks of the day. Okay. I think you guys have seen every day in biotech, there are at least about 3 or 4 hot stocks that everybody is playing. Okay. So those are the stocks that are most likely to experience these kind of squeezes. Okay. Nobody is going to go after a stock which nobody is looking at. Okay. Remember, if nobody is looking at it, there is no volume. There is no strong action all day. So these short traps are not going to work. Okay.
Yes, Mark, quick question. On shorting, right?
Yes.
I don't have much experience into this, but it does depend on, say if you want to short a stock.
Yes.
How many stocks you can borrow? Does it depend on your settled cash or available cash in your?
Of course. Yeah. I mean, of course, you need to have enough money in your account. That's a pretty given, right? And also, you need to have margin enabled on your account. Okay. And you need to have the hard to borrow enabled on your account. Okay. In my broker is TD Ameritrade. All it takes is a quick phone call and you tell them. And remember, because these are hard to borrow stocks, they usually give this permission only to accredited investors, which means I believe, I think you need to have at least $100,000 in your account or something. Does anybody remember?
That is correct. That's 100K.
That's what I remember. 100K minimum. And remember, there's a high interest rate, like I mentioned. Okay. So yes, it goes back to the old saying that you need to have money to make money.
and also, Suman, I think one of the criteria is when you ask for this margin, you have to give at least a few years of experience. I don't know if that's going to be a qualification or not, but they ask your trading experience, all those things.
Yes,
I believe that's probably related to, yeah.
Yes, yeah. They don't want, if you're a newbie who's never traded stocks or just been trading for 3 months or 6 months, the broker will not give you this access because, and again, this is a verbal, honor system answer. Then there's no way for them to verify how long you've been trading, right? So it's for you to tell them. I mean, end of the day, remember, the broker is also trying to reduce risk for themselves because if you get burnt on one of these trades, you're going to probably be mad at that broker too, for whatever reason. And they end of the day are losing a customer. So they don't want unhappy customers. I think we have seen the episode with Robinhood, how they got squeezed with GameStop, it was a total mess, right? And we're going to go over that a little bit during the lessons. But yes, so make sure you have done all that homework, make sure you have 100K in your account, make sure you have margin turned on, make sure you have hard to borrow enabled. And then if you feel comfortable and you know how to play these, man, you can make a lot of money in this market right now. So it's a very, very unique time we're in. Okay, any other questions?
Suman, one more question.
Yes.
So, so on the short trap that you're explaining,
Yes.
do we need to look at the end close of the market only? Because the similar setup was going to happen at 1 p.m. or 1:20 p.m.
Yes, yes,
right?
you're right. Remember, short traps happen all day. Okay, it's the same idea. Okay, somebody shorted, the stock is going down. Okay, the person who shorted feels comfortable, like, okay, good, the stock is done. It's done running up, so it's going to go down. And right when they feel complacent, then the bids start coming up, and then the shorts start covering, and boom, the stock goes up. So that happens all the time. This particular example I'm giving is for after hours.
Oh, okay, gotcha. Yeah.
Okay, so in normal daytime trading, during core trading hours, you're not going to see a stock go up 50% in 30 minutes. That's rare. Or, you know, the way Oxygen went up 300% in 2 hours. That's very rare during regular trading hours. That happens more during after hours. Why? Because the volume is low. Okay. And the other thing that happens during after hours is usually by end of the day, there are very few borrows. Brokers can't even find you shares to short. Okay. Remember, shorting means selling. Okay. Now, if there is no way to short the stock, which means there are very few sellers. Okay. And everybody who's trading the stock is basically buying the stock, right? They're buying to cover or they're buying long. So now you have a lopsided buy side bias, right? And that's exactly why the short squeeze happens. That's how the stock shoots up. Does that make sense?
Gotcha.
Yeah. Suman, this is Venkat. Is there any way, like, if this short squeeze happens after hours, the TD Ameritrade or whatever the broker, if I don't have a good margin account, will they sell it?
It is possible, yeah. I mean, Venkat's question is, you know, basically a margin call in the after hours. You know, these days, margin calls can happen anytime because everything is automated, right? Everything is rules driven. If your margin account, you know, drops below the threshold, so for example, you know, you bought, you know, Oxygen as a short seller at 5.5, okay? And now, you know, you bought 1,000 shares. And now the share is at stock is at 7.5. Okay, so you just lost $2,000. Okay, because from 5.5 to 7.5, it's $2 a share, and you have 1,000 shares. Okay, so that's a pretty big move. In terms of percentage, that's like what, 35–40%. And if you have all your eggs in one basket, say you bought 10,000 shares, and you have a small account like 50K or something, you're in trouble. Guess what? Your broker might liquidate you. And it's the same thing, right? When the broker liquidates you, he's buying to cover. Again, same thing. You're creating more demand for the stock. And you just got liquidated, you know. If you had 10,000 shares in this example, yeah, sorry, you just got 20 grand. And remember, after hours, your stop loss orders also don't work. So it's very risky. Stop loss orders work only during regular trading hours. Okay, that is 9:30 to 4 p.m. Eastern. So if you are going to trade a stock like this, you got to watch like a hawk. You cannot be complacent because these stocks are very volatile. Hope that makes sense. I'm not trying to scare you guys, but you know, it's very important for you guys to understand, you know, there is no easy money, right? There is risk everywhere. Risk and reward are always proportional. So if you think the stock you bought at 5.5 is going to drop to $3 and you're going to make a ton of money, you know, then the reward is high, which means the risk is high too, which means stock can go the other way and you're screwed.
Another question, Suman, it might sound dumb, but say after you short, is there a time frame for that person to cover the shorts?
No, there is no time frame. It's up to you. If you have a large account with, you know, tens of thousands of dollars, you're just going to keep eating into your account. That's it.
So more time, they make more money based on the interest.
Yes, but remember, you're not realizing the loss until you finish the trade. Okay? So oxygen may go up to 20 and then it may come down to 5 in 1 month. In which case, of course, you're probably going to lose some sleep and it's going to be very painful for you. But eventually, if the stock comes back to 5, you're fine. But sometimes the stock may never come back because the people who are adding the shares at a higher price, feel comfortable, or, there could be positive news. It could be a real company. For example, BNGO, what is that? Biagnamo or something? Can't remember the exact name. So BNGO, I think you guys have all probably seen that. BNGO used to be $1 stock. Okay. Now it is like what? Much above $10. And it's comfortably settled. So it's not going to go down anymore. And I think some of the folks on our group also said they actually are customers of BNGO. And, it sounds like a legitimate company. So, for it to come down is probably not going to happen. So if you are short BNGO from like say $4 or $5 and it's like, $12, $13, $14 now, you're probably going to be, losing money for a long time or never be able to make up that money. So in that case, you just close the trade and eat the loss. You don't have much of a choice. I see one question here. Why not be the long investor when you see this action? That's exactly what I'm saying. That's exactly what I'm saying. A short squeeze means that you want to be long. Okay? So that's exactly what I did with Oxygen. I bought the shares at $5.30 when I saw this action of a short squeeze. And then I rode it from 530 long all the way till about $9.50 or something, almost 100% return. That's exactly the idea. Why would you want to short before a short squeeze when you know it's going to squeeze? That doesn't make sense. You want to be long. Yes.
So Suman, extension to that same topic, right? So you want to be long on this short trapped stocks. So identifying these, right? So we just have to see the top gainers for the day or go look at the high short interest list of stocks. I think there's a website.
High short interest doesn't matter a whole lot for, these small low float stocks. Okay. High short interest is a different type, okay? Like GameStop. I think we all know that story now very well, right? GameStop had 130% short interest. It's ridiculous. It's like meaningless. What that means is that people are borrowing from or the same person is letting multiple people borrow their shares. So say, for example, I'm a long investor in GameStop. I have 100 shares, okay? My broker is using my 100 shares, okay? And borrowing those 100 shares to multiple people. Okay. Why are they doing that? Because they make money on the interest, right? It's free money for them. They're making like, whatever, $50, $100 for, every 100 shares or something. Okay. All is well until the massive short squeeze happens, like how GameStop happened. So what happened? Now the broker, like Robinhood in this case, I'm sure you guys have heard that, Robinhood had to go and buy in the market long shares, okay, to cover the shorts. And because they borrowed one share for every, to 3 customers instead of just 1 customer, 1-to-1, it created a massive short squeeze. And the other thing that happened is obviously, you guys know about the whole Wall Street bets and Reddit. But really, the guys who really manipulated the system are other hedge funds. Okay. There are big hedge funds involved here like Citadel and Cohen and all these guys. You guys have heard those names, right? But other hedge funds, they bought millions of shares of GameStop long side to squeeze the market. So retailers are fine. Okay. Retailers can buy 100, 200 shares, but these hedge funds were coming with hundreds of millions of dollars. They were the guys who actually moved GameStop. Nobody knows much about that. Nobody wants to talk about it. The media doesn't say much because that's not such a cool, sexy story, right? It's more fun when you hear that, you know, a bunch of, you know, Reddit bloggers squeezed it, you know, 20-year-old kid sitting in some basement, right? So that makes a better story. But
I mean,
the real
that's what-
story is that other hedge funds squeeze them.
That probably happened when they try to rotate their cash from other long positions into covering this shorts, right? So that's why we saw correction in the tech industry.
Exactly. So yeah, so just to answer your question again, how do you identify this? You know, there are stocks which are trading multiple times above their average volume. Okay, in OCGN's case, I think it was trading about 100 times the average volume. Okay, and all the traders are trading it. That is a simple thing, right? That's how the volume is created. Otherwise, where will they get the volume from? Okay, and then all these other conditions, you know, there was some positive news, you know, something in the hot area like COVID or Alzheimer's or whatever, cancer, you know, these are the, you know, big diseases, right? Health issues, which have a huge addressable market. So that is going to get everybody's attention. And then they are low float, and, you know, they tend to be on weekends, you know. So all these conditions, and then the setup, like I mentioned, strong action all day, heavy volume, but some weakness towards the close. That is the key thing.
Thanks so much.
Okay. All right. If we're good with this slide, I'll go to the long trap. Okay. Now, long trap is pretty much the opposite. Okay. You can see that, you know, these things work on both sides. Okay. Oxygen can squeeze 200, 300% in a day. It can come down, you know, 50, 60% in a day. Okay. So it's the same thing. So typical characteristics is the same thing: low price, low float, low, you know, $10 to $20. You know, remember, I increased the price from 5 to 10 to 10 to 20 because remember, it's already squeezed higher. It's already up 200, 300%. Okay. And then the other thing is companies likely do a secondary offering to take advantage of the price. Now, you guys have probably seen, you know, I type in a lot of times, everybody, you know, if somebody is doing a secondary offering, just in case somebody is not familiar with it, you know, I'll quickly explain what a secondary offering is. Now, the primary offering of a stock is when they go IPO. Okay. IPO, as you guys know, stands for initial public offering. That is when you sell the shares of the company to the public for the first time. Okay. That's the initial offering. Any other time the company wants to sell additional shares, okay, that is called a secondary offering. Okay, nobody keeps account of it. It can be the 10th time, they still call it a secondary offering. Okay, so don't get hung up on the word secondary. So that's why, you know, most traders use the word offering, because that's when you know they're offering more shares. And what does that mean? If a company is adding more shares, that means there's dilution. Right? Very simple. If a company had only 100 shares in the IPO and they want to add another, you know, 25 shares, okay? Now suddenly the value of the company is divided by 125 instead of 100. Okay? So the value of the company technically has gone down 20%, right? So that is what a secondary offering is. So obviously offerings in general are dilutive and bad for existing shareholders. What that means is the share price is going to drop to adjust to this new price. But of course, we are in 2020 and 2021. Nothing makes sense. As you guys have seen, in many cases, after the offering, the stock has actually gone up. Okay. There are some circumstances where it does make sense. Okay. So for example, you know, a company is, you know, struggling to fulfill their purchase orders. Okay, they have a great product, okay, and they're getting tons of orders, but you need money to fulfill the purchase orders, right? You got to pay your manufacturers, your distributors, and blah, blah, blah. So for that, they may say, okay, you know what? I'm going to do a secondary offering. I'm going to do an additional, you know, 10% shares. Okay, but I'm going to use these proceeds, these funds, to pay for those manufacturing costs so that I can fulfill those purchase orders and make even more money. Right? They may have like a 50% margin. So, of course, it makes sense to raise 10% offering additional shares and cash to pay for those, to create that extra demand. So that's a good thing for the shareholders. Shareholders like, you know what? I don't mind 10% dilution. You're going to make even more money. So that makes sense. But obviously, that doesn't make sense in all the cases. Okay? These days, 90% of the companies, they're simply offering secondaries just to pocket that extra money. Okay? Because they know their stock price is very high. And there are a lot of people who are willing to pay at that price. Okay? They will be suckers or whatever you want to call them. But the stock price is actually going up as if it's a good thing. And in many cases, it's not really a good thing. Of course, they can put a spin as if it's a good thing. They can say, like, for example, when OCGN did their offering, they said like, oh, you know, we're going to use the money to expand our R&D efforts and we're going to hire more salespeople and this and that. But we all know that, first of all, that particular vaccine from Bharat Biotech has, in my opinion, zero chance of getting an approval from the FDA. Okay, so they're never going to enter the US market. Okay, so the whole premise is a sham. I mean, think about it. AstraZeneca, which is from, you know, one of the top companies, and they had Oxford involved in the whole research and clinical trials, and they have what, like 73% or something efficacy rate, and they don't have an approval from the FDA yet. Only 2 companies have the approval so far, right? Moderna and Pfizer, that's it. Even Johnson & Johnson, you know, we don't know if they're going to get the approval or not. They might, but they're still only in the 70s, their approval rate. The big advantage with Johnson & Johnson, of course, is that single shot, you don't have to do twice. So maybe FDA will think like, okay, you know, that will help speed up the process. 70% efficacy is better than nothing. And, you know, the logistics will be easier with, you know, only one shot. So anyway, so that is one thing. But you guys understand, right? So generally offerings are bad. And again, we're talking about a long trap. What long trap means? The long investors think that, oh, the stock is going to keep going up, but actually the stock is going to go down. Okay, it's the opposite of the short trap, where the short investors are thinking the share will go down, but the stock actually goes up. Okay, so now what is a typical setup? So the stock has had a multi-day run. Okay, in case of Oxygen, I think it was like 3 or 4 days. You know, heavy volume and everything. But then the volume starts coming down, right? Obviously, the traders are going to find something else to trade. That's what we do, right? There's going to be some other stock that's moving, some other news that is hot, you know, something else in the market that is more exciting. And when the volume is coming down, we call that exhaustion. Okay, you're exhausted, right? The stock is exhausted. So as you can see, so I have 2 charts here for Oxygen. Okay, the first one is a 1-hour chart. Okay. So this is over 3 days. It doesn't show the beginning of, I think towards the end of Friday, but you know, it shows. So then you see the Monday, it went up, boom, 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 boom. Okay, went up all the way to 1877. Okay, very nice, right? But is somebody looking at the volume? Look at the volume, how the volume is coming down, 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 down. This is quite a drastic reduction in volume. Okay, so the peak volume in 1 hour was about 5 million shares. That dropped to 4 million, then that dropped to 3 million, then about 2 million, you know, whatever, 1.5. So rapid drop. And remember, this is an hourly chart, not 5 minute. Okay, so this is exactly where I knew this was a long trap and I shorted it. Okay. So look at what happened. Okay, now let us look at the zoomed version. This will be easier to read. Okay, this is a 5-minute chart, so it's easy to read. So this was again towards the end of Monday. Again, this is Central Time, 3 p.m. Central. The stock shot up. Okay, so all the longs were like super happy, right? Oh, this is great, you know. This will make new highs, you know, this will go crazy. Tomorrow it will run again and this and that. But they did not see what the trend is. The trend will show a lot better in a 1-hour chart than a 5-minute chart, right? In a 5-minute chart, sure, there's a spike at the last 5 minutes of the day. But the truth is that last 5 minutes of the day here, last hour of the day, was the lowest volume of that entire day. That is more significant than this 5 minutes. So to me, that was a long trap, and that was the time for me to short. So I shorted around $16. Okay, again, these stocks move so quickly, right? You can never hit the top perfectly. Sometimes I get lucky, sometimes I can't. Okay, so I hit the short around $16, and sure enough, right then, immediately during after hours, it started dropping. Why? Same reason. So look at the setup again. Weak price action all day. Okay, look at the price action. It topped here 1877 and then it started going down, right? So that's weak price action. And then volume is coming down. Look at the volume. And then there is weak price action with some strength towards the close. Remember, this is the exact opposite of the weakness towards the close that we saw for a short trap. Okay, so what is the strength towards close? This spike right here, right? So if you are a long investor, you're very happy, right? Oh man, that's awesome. You might have bought it at like $15 or $15.50. Nice, it moved up. That means it's going to do well. But then what happens? During after hours, some longs decide to sell. Okay, because if I bought it at like $15, okay, and it's up at $16, I might think like, you know what? I'm happy. I'm happy with the 7%, 8%, whatever I'm making. I'm going to get out. Okay. And remember, the volume is not much. Okay. So the supply and demand are already skewed. There is more supply than demand. And then once a longs decide to sell, the stock moves down. And this attracts the shorts. Again, exact opposite of the short squeeze, where the longs got attracted because the stock was going up. And then the shorts hit it, and guess what? The longs start getting scared. The longs start dumping the stock. Boom, 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 boom. Look at this. From 3 p.m. to 4:30 p.m. Central, in an hour and a half, it dropped from 1650 to 1379. Okay? That's a pretty significant move, about what, 20%? So, and that obviously means that next day will be a bloodbath, and that's exactly what happened. So I held the shares. It went down all the way to 1150 the next day. So that's where I covered. And then, of course, the next day again, it went to $10. I was not patient enough, but I was happy. I shot it from $16 to 1150. That was a huge win for me. That was like what, 35, 40%. So I was very happy with the trade. So again, the short squeeze, the potential to make money is obviously more because it's going up 200, 300%. The long trap or, buying to short this stock, sure, 30% is not bad, but, it's not like the long squeeze, the short squeeze and the long side, where you can make a lot more usually. So if there is a setup, I'll play on both sides. I don't care. 30% is nothing to sneeze at. I'm very happy with 30%. Of course, I'll be happier with 100% or 200%, like how I was able to trade on the upside. So this is how a long trap works. And basically, the opposite of an after hours squeezer is an after hours rollover. And that's what this is all about. And have you noticed something about both of these scenarios? The key thing here that's dictating all these trades is trader psychology. Isn't that interesting? It goes back to the good old two sentiments that drive the stock market: fear and greed. Here it is greed. Of course, there was fear first, which triggered the greed. And in this case, it's opposite. First, they were greedy, but then they got fearful, and then boom, 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 it went down. So trading is a lot about psychology. So you got to understand how traders think and be able to be on the right side and not be biased. It's very important to be not biased, because it's very easy to get biased saying that, oh, I know what I'm doing, and then keep losing money, not a good way. Most of the times I just cut my losses. you know what, it's okay. I'll find another trade, because
Yeah.
me being able to sleep in the night is also important.
Yeah, Suman, one thing I want to add is I think that's a really important point, because on that day, our whole world kind of revolves around, especially if you're making money,
Yeah.
on either short or up, you just think about that. But
Yes.
I think if you look at from a macro level, right, let's assume that everybody has, let's say, 50K in their account. They probably have these Microsoft and Googles and 20,000.
Yeah.
And 20, 30,000, they will have the AMDs and all these things, right? For a little more long term.
Sure.
And everybody has a very short amount of money that they can invest in, leverage for these things. So if you lose the momentum, it'll never come back. And everybody's going to focus on the next thing tomorrow.
Yes.
So even though we think that day, that thing is everything, but we have to kind of,
Exactly.
cut the emotions,
Remember that
which is what you're saying.
Exactly. And remember, these small companies are very good with PR. They will make their news seem like, they are curing cancer, they're curing Alzheimer's, they're curing COVID. But trust me, these small companies, 99% of the time, it's all BS. So
No, but if they are, Amazon or Google would have bought them long time ago. So
Exactly.
there is that other point too, right? Or some other company.
Exactly. Or one of the large pharmas, right? Like Pfizer or,
Yeah, exactly. Yeah.
Yeah, because these are, micro caps compared to what those guys are. Okay. All right. A couple of questions. How many times can they do offerings? There is no limit. It all depends on the investor appetite. If I can keep selling you $10 million every day in the market and the stock price is not going down, why would I not? There is always a sucker to buy. Why won't I sell them? Right? That was actually one of the questions that a lot of people were asking about GameStop. Why wasn't GameStop doing a secondary offering? It is still somewhat of a puzzle, by the way. If you guys Google, there are a lot of articles about it. And the longs loved it because GameStop was not doing offerings. Because typically, when the stock price is high and a company does offering, what that means is that the management is trying to take advantage of the situation. They're trying to pocket money. They're trying to raise money. And that money can go towards R&D, it can go towards purchase orders, growth, whatever. But it could also go towards their bonuses. Nobody knows. There are no restrictions. It's all dependent on whatever the company wants to do. So there are really no limits for offering. A lot of the smart companies, they're doing multiple offerings. I think BNGO did like 2 or 3 offerings till now. They are just raking it in, why not? If the investors are buying, why not? Okay, one more question from Hari. Yeah, is it bad for the dilution? Yes, typically it is. And yeah, I mean, it needs to be approved by the board of directors and all, but these are all small companies, man, and nobody cares, The board of directors is probably the guy's friend or brother or something, I mean, everything goes. They're all about making a quick buck. Okay, the last one. One more. Probably the long trap doesn't apply to Tesla. It went up when it had offerings. Again, remember the example I gave you. If you are doing an offering for a good reason, like Tesla, when they did their offering, they did offering multiple times, of course. One of the offering that they did last year, they said they are doing it for expansion of the Gigafactory. Okay, their battery factory in Austin and Nevada. Okay, now that's a good thing, right? If Tesla can use that money to create more batteries and produce more cars and sell more cars, the investors are happy. That's the reason the stock did not get a hit. But again, remember, Tesla is a cult stock. Okay, there are so many people crazy about Tesla. It doesn't matter. It has been bulletproof. I mean, if you guys read their annual report carefully, they actually make very little money selling cars. Most of the money Tesla makes money, most of the way Tesla makes money is through carbon credits. If you read that, it's very fascinating. What carbon credits is that, the government requires all companies to have an impact on carbon footprint reduction in the US. And if they cannot do it themselves, they can buy these credits from somewhere else. There is actually trading in the Chicago Mercantile Exchange for carbon credits that happens. The price fluctuates. And companies like Tesla, which are using all solar power and, electric cars and all this stuff, they have excess carbon credits. So they're selling these carbon credits to other companies, and that's how they're making money. And the irony is that to get those carbon credits, Tesla is getting a lot of subsidies from taxpayers. There are a lot of government subsidies, right? Both for the company and the customers. If you bought a Tesla, I'm sure you remember, you got a nice tax write-off that year. Okay. So Tesla is a bit of a unique situation. And a couple of years ago, when they did another offering, they said they were doing it for their Shanghai factory in China. Again, people were like, hey, they're going into China, new market with 1.5 billion people. Why would you say no to that? I'll give you money, right? That's why Tesla was going up. So offerings did not impact Tesla. Okay, what else? Is there any impact on volume during short trap? Like I said, the volume is typically high. You have heavy volume going into the short trap, okay? And then it increases in the after hours too, or stays at the same level as the regular hour. This is a 5-minute chart, so it's not a great example, but if you look at an hourly chart, you'll see clearly the volume has been building. So the volume is, a big factor, yes. Okay. There was one more question, I think. Okay. Is it good to have a stops sell set up for stock in case you are not paying attention? Yeah, stop loss, I think that's what you meant. You always want to have stop losses. Even if you're paying attention, you want to have stop losses because stocks can move within seconds. So if there is a big news and you're on the wrong side, yeah, you'll be in trouble. Both sides, right? For example, you're on the long side of a stock, okay? I'll give you an example, the new one, right? Clover, the Chamath company, CLOV. Suddenly a short seller report came out from, was it Citron or Muddy Waters? I can't remember. Whoever, they had a short report, right? And boom, the stock was $14 and it went down to 13 and then 12 and below 12, all within like a few minutes. And if you are even by your screen, you sometimes don't know how to react. So in my opinion, always have a stop loss. If you had bought the stock at $13 and the stock is $14 now, I would put a short loss at maybe like, $13.50, where, I'm saying like, okay, even if the stock fluctuates, I'm going to have half my gains. I'm not going to lose the entire $1. At least I'm going to capture the 50 cents. Same thing on the short side, right? If you're shorting your stock, suddenly some good news comes or a short squeeze happens. The stock might just zoom. Like, for example, if you were short on GameStop when it was $30 and didn't have a stop loss and it went up all the way till what, $450 or something crazy? Yeah, you'd be kicking yourself, right? You'd rather lose like, maybe $2 or $3 on the stock rather than, deal with a nightmare scenario for multiple days. And, GameStop has never come back to 30 since then. So, all right. Based on volume, can you determine whether the stock is going up or down? No. What you want to do is look at price and volume together. Okay. That is what is called price action. So you want to see, is the price of the stock going up while the volume is going up? Then that's bullish, right? That means more people are coming and buying, and that is what is pushing the stock up. On the flip side, the volume is coming down and the stock price is, maybe popping a little bit. I would actually think about shorting the stock, because what it tells me is that, okay, it is coming close to exhaustion. Remember this example we gave you? Multi-day run, volume is coming down, so exhaustion. Okay, so there are not enough buyers left. Okay, so that is when I would actually short the stock. All right, I think there was one more question. Which broker shows real-time volume? Any decent broker shows, man. I use Thinkorswim, they all show real-time volume. Any decent broker, TD Ameritrade, Thinkorswim, E-Trade, whoever, they all show real-time data. If they are not showing real-time data, call them. They'll probably enable it because I don't know of any broker who doesn't have real-time data on volume. Otherwise, they wouldn't be a broker. Okay. All right. I think we spent like over an hour on this topic. So I'd like to move on to another slide unless someone has any questions. Okay. Any other questions? Last call.
Suman, when the offering, as soon as company announce, we see the price change immediately.
Yes, as soon as it's the news, right? There's a dilution. So typically the stock will go down. Yes. But then, if the company is successful in spinning the story that, the dilution is going to be beneficial for shareholders because it's going to generate more sales, more revenue, more profits, then, and the investors believe it and analysts are upgrading, then an offering may not be a problem. It might actually be more like a boost to the stock. So.
Suman, I want to emphasize the stop loss, right? Unless you're betting on something where it's going to go, like 4 or 5x or whatever, that's fine. But anything else, I think you should, everybody should do stop loss, because doing and not doing, you'll probably have a change of 20% gain that you would have had you did not have, or even more. So just take that seriously. It's super important, especially we are kind of living in a crazy world where we don't know why things are moving, and they will be that way.
Yep. I mean, very often, right, we see a stock is moving 10, 15, 20%, but there's no news because some guy on Twitter pumped it. We find out later. Some guy in some Discord chat room pumped it. We find out later. So it's all kinds of crazy things. And they're usually low volume companies. So moving 10% on a stock is not so very difficult. If someone has a couple of $1 million, they can move the stock 10% these days. So yeah. And remember, stop losses do not work during pre-market and after-market hours. Okay. But, the trading hours, the key trading hours are like bulk of the hours. So it's still very beneficial. So I recommend everybody to have a stop loss.
Hey Suman, what is your guidance on trailing stop versus a stop loss?
Trailing stop is not a bad idea. This is basically, again, not for a fast moving stock.
Okay.
It's probably for a slower moving stock. I use, typically, like something that's been going up. And again, it depends. So for those of you who don't know what a trailing stop is, by the way, I'll just quickly explain. A trailing stop is where the stop loss is not at a static position. It keeps moving along with the stock price. So for example, when Clove was $13, you may have your trailing stop at $12.80. But when Clove moves to $13.50, your trailing stop will also move up 50 cents. So it'll become $13.30. Okay. So it is good that your trailing stop goes up, but if it is a volatile stock, which goes up and down like 5% every 2-3 minutes for no reason, then your stop loss will get triggered right away. So it's not very useful. But for certain stocks, it is useful. Yeah.
So usual guidance is like 10-15% if for a normal run.
Yeah, I mean, again, I am a big believer of locking profits. I don't have a problem leaving 20% gains on the table as long as I lock 20% of the gains with me. Because nobody knows for sure where the stock is going to go. I'll give you a recent example on Hyliion, right? HYLN. Mm-hmm. I had the shares at like $15 or $16. I can't remember. I sold it around $18. I was pretty happy. I made 20%. But the darn thing kept running. It went to like 22 or something. And, of course, I feel bad, but then, it eventually came back to 19. So, these things just fluctuate. So to me, I'm happy to lock those gains because, somebody may come with some press release and say, oh, you know what, that battery news is fake. They already had that news 2 months ago. They're just pumping it again. Or, they say like some caveat, the battery is not approved, or they have a patent issue, or who knows what news will come out. And suddenly, the stock will turn back. So if I'm happy locking gains, I'm very happy because end of the day, I would rather lock the gains and be ready with that capital to deploy it on another trade.
And also, when you want to lock, right, you can also use stop loss, but a very tight stop loss, because sometimes you don't know what it is, and just, maybe a few cents, or depending on what the bid price is, do a stop loss. Then if you're already up, right, maybe 10% or so, you can lose that extra 1%, maybe it could be 9%. But just in case it shoots up, right, you might be in a better position to capture that.
Yes, exactly. That's a good example, Emerson. Like, maybe I should have used a trading stop for my highly on order, instead of just a limit order to just sell it off,
Yeah. And one other thing is, again, this is kind of, I tried it a few times. Like, say, if you already want to lock, right? When you already want to lock and there is so much volatility going on, what you want to do is you want to put 50% on a tight stop loss, and put a 50% on a little more higher, maybe a 5% more. So you want to see where it goes, right? So sometimes they shoot up so much for obviously no reason, and then they come back. So, you have to play that around to maximize after you make a decision.
Okay. Thank you. By the way, my name is Vinod. I failed to introduce myself, but thank you very much, guys.
All right, Dhruv has a question. Isn't a limit sell order the same as a stop loss? No, it's not. Very different. So a limit sell order, you're basically saying that, okay, the stock is $13. I want to sell it at $13.50. Okay. Stop loss, what you're saying is that if the stock goes below a certain number, that's when you want to sell it. So if you bought the shares at $12.50, okay, maybe you want to, lock your profits no less than $12.90. So then you want to say, okay, my stop loss triggers at $12.90. So if the stock drops below $12.90, then it becomes a market order, and I just liquidate the stock. A limit order is very different. Limit order, you're simply saying that when a stock price goes to a certain price, which is usually higher than the current price, that's when you want to sell it. That's it.
Yeah, and a couple of more on limit orders, right? So especially when you bought a stock pre-market or the day before, and that it's going to go up to the next day, and before Robinhood pop, like, say, for example, or even right after the open, what you want to do is you want to put a higher limit. Like, just put a higher limit, for maybe 50%, 25%. And see, because it's very difficult to react when it shoots up so much in a short period of time, you can't catch it. So you put a limit and see where it happens, or even put a stop loss if it is post-market. Again, this is very temporary. No, don't do it for long-term stocks, right? If you want to make money quick, and that's the reason you bought it, and these are the things you want to try around and get comfortable with to maximize your strategy.
Yep. Okay. The other question is OCO. OCO stands for one cancels other. So this is called a bracket order. So yes, so typically what I do is I put a bracket order with a stop loss and a limit order. Okay, so I get best of both the worlds. I'm saying that, okay, if the stock is going to $13.50 from $13, I want to sell it. Okay, and when that triggers, it cancels other. That's what is OCO. One cancels other. So the stop loss doesn't make any sense, right? I already sold it. Similarly, if the stock goes down to $12.90 in that example I was giving, the stop loss will trigger and it will liquidate my stock at $12.90 or whatever the market price is, and my other order for limit will get canceled. That's it. So what is better, stop loss or trailing stop order? Trailing is basically a type of limit order, and stop loss is a stop loss. So they're two different things. So you can do an OCO with both of those rules. All right, next question is from Jay. EV and bio sectors are hot. Do sectors change every year? Well, there is no timeline, right? Nobody's going to tell that, okay, it's January 1st, no more EV, right? It all depends on investor sentiment. So yes, they both are very hot. They continue to be hot. So we'll see what happens. Okay. All right. I'd like to move on to another topic because, I think, we have spent an hour and 20 minutes already on just 2 slides. So I just want to recap a few things. This is more of trading lessons for me that I captured for 2020. Okay. The first one is the most important one. Don't fight the Fed. Okay. The Fed is, of course, a Federal Reserve. As you guys know, the United States Federal Reserve has the luxury of printing unlimited cash, okay? Because the US dollar is the world's reserve currency. What is anybody going to do? They don't have a choice, okay? Every commodity is traded in dollars. Oil, okay, gold, silver, okay? 90% of the trade in the world happens in dollars, okay? So dollar is a de facto currency. And if the Federal Reserve wants to print another $1 trillion, nobody has much of a choice. And that's the reason why you guys have seen the dollar is not even depreciated, okay? But we're in a very unique situation. See, we never had a pandemic, right? Typically a recession is more regional, okay? The US might get hit, China might get hit, the Asian countries might get hit, or Western Europe might get hit, and they do the monetary policy, right? They start printing. If it's a European recession, then the ECB starts printing money. That's what is fiscal power. And, the euro will get weaker. But in this case, everybody is printing money. Everybody, right? Every government has no other choice. They have to do the fiscal power to make sure that, the government survives, their employees, their citizens get through tough times, and all that stuff. So that's the reason, there's a big gap between Main Street and Wall Street, right? And we'll talk about that in a little bit. And the next thing is, just like don't fight the Fed, which is adding all this cash and liquidity into the markets, don't fight Congress, okay? The US Congress, the House of Representatives, the Senate, have again unlimited spending power, okay? Remember, the Federal Reserve creates the money and Congress spends the money. Very simple. Okay. And how do they spend the money? Of course, they have debates and they fight with each other. I think we are all familiar with that. But end of the day, they send out the stimulus checks. They are doing the PPP loans. Okay. All kinds of ways, right? They are giving money to the state governments to run the whole COVID vaccine operations. US is one of the few countries where, COVID testing was 100% free, COVID vaccines are 100% free. It's nice, as a citizen, I feel like my taxpayer money is working. But of course, this is not really taxpayer money. This is money that the Fed is printing out of thin air and Congress is nicely spending that money. So end of the day, these are all, debatable things. I don't want to get into politics, but the bottom line is that if Congress is going to spend another $1.9 trillion as the new stimulus bill is going on, don't fight it. Okay, that $1.9 trillion is going to make its way to the stock market, and when it makes its way to the stock market, stocks will keep going up. It's as simple as that. Okay, figuring out which stocks will go up, which sectors will do well, that's a different story. But okay, that's what happened in 2020. Okay, and the trend is your friend. Okay, momentum is very important. Don't try to fight it. Okay, retail investors can be a force to reckon with. I think we have seen that. A lot of us are retail investors. Most of us are not trading on a regular basis, but I think now that we have the luxury of work from home, we have a little extra cash, and the market is really ripping. We're all excited. We also want to make a buck out of it. Why not, right? And then Wall Street and Main Street are worlds apart. I think we know that, right? Unfortunately, a lot of the service industries, especially in the travel and hospitality and food and beverage, they have really, really suffered, right? And these guys are the ones who make the lowest salaries, but, they lost their jobs and they've been, depending on the stimulus checks. So on the other hand, folks like us who are mostly in IT are very blessed. We have our jobs, we get to safely work from home, and we are deploying our capital to make even more money. So, it's a big dichotomy, And then the other thing we have seen is that panic selling is always the wrong move. Okay, in 2020, those who dumped their stocks during the COVID bad news in March, if they didn't come back in, or if they didn't stick with, the downside move, they lost a lot of money. Okay, both in terms of real money and also opportunity cost, right? So panic selling is, not a great move, especially when you have the top two bullets, right? Don't fight the Fed and Congress. Fed and Congress are helping the markets. So, markets are not going to really go down. That's my take. And then having cash in hand is essential for one of the examples that we just gave, right? Especially if you're shorting stocks, you better have a lot of ammo, because you don't want to be liquidated if you're on the wrong side of the trade. Okay. And again, if you have the proper protection like stop losses, you won't find yourself in that bad situation. So hopefully you don't have that problem, but you need to have cash in general, because you might find a great opportunity and you don't have cash, then you can't play the game. Very simple. Okay. And then a couple of my favorite quotes, when the facts change, I change my mind. I'm a big believer of that. As you guys have seen, the facts have really changed from 2020 to 2021. As I mentioned, momentum is the game. Stocks are overvalued, market is overvalued. I mean, S&P earnings are 35 times currently. Okay. Historically, it is 15 to 20 times. So you can see how overbought this market is. But you know what? The facts have not changed. The Fed is still pumping money. Congress is still spending money. So who am I? Let us play the game till the music stops. That's the way I look at it. Okay. We will see signs. Okay. We are of course not going to leave it to luck, right? As you guys have seen, whenever the market is weak, like when it was weak 2 weeks ago, when it corrected to 5%, I wouldn't even call it a correction, just a pullback, right? 5% pullback. We were watching the VIX very closely. Okay. UVXY, which is a derivative of VIX, is something I watch constantly. If UVXY, which is the fear index, which you guys know based on the VIX, is moving up, you better pay attention. Okay. And that's when you'll see, I'm trying to liquidate my longs, I'm going to try to stay more cash and maybe even start adding positions on the short side, like TZA I bought the other day. It's not a great trade. I made I think 5% or something. But, you got to adapt. So when the facts change, I change my mind. So you have to be really open to changing when the conditions are changing. And then the last one is an interesting one. The market can stay irrational longer than you can stay solvent. Okay. Great one, that Keynes said. That's exactly what I just said, right? The market is overvalued, but don't try to short a market which is overvalued, thinking hey, it's overvalued. Historical, it should be 15 to 20 times. Now it's 35 times. It makes no sense. All the stocks will come down, but will they? I don't know. When will they? I don't know. So I'm going to keep playing the game. So the market can stay irrational until you can stay solvent. So if you're on the short side of this market, you're going to get screwed. All right. Now moving on to 2021 observations. Okay. Same top two bullets. Nothing has changed, right? The Fed is still pumping money. Congress is still spending money. So don't forget that. And they're also keeping the rates at zero. I don't know if you remember hearing the Federal Reserve Chairman saying they're not even thinking about increasing rates. Isn't that interesting? Basically they're saying it's going to be zero rate, 0%. And that's why the mortgage rates are low. So there's a housing boom. Okay. Easy money to borrow, at 0%. I'm going to borrow and put it in the stock market. That's what people are doing. The big hedge funds and all the big guys. Okay. Same thing. Don't fight Congress. The $1.9 trillion is going to go through. We know that. And after that, there'll probably be another bill for infrastructure. Who knows? It's going to be spending like crazy, because all that money, the hope is for them to create jobs and, basically kick the can, Of course, we're adding a lot of national debt and deficit, but that's not in our kids' problem. That's our grandkids' problem. So, for now, there's no point arguing all of these things. It is not a moral argument or any of that. It's simply for us as traders have to understand the facts and take advantage of the situation. That's a simple way I look at it.
And I think the Senate and Congress being on the same side of the party, but can only help to boost things like that. Again, I think maybe an optimistic view, but that's possible. So keep that in mind. The reasons why it could push to add more money to the economy.
Yes. And one thing I would caution over there, other than VIX, the other thing I watch is the bond market. Okay. So for those of you who are familiar with the bond market, you know that if the bond rates keep going up, which is your 10-year yield, typically that is like a big benchmark number. The 10-year treasury yield, if that keeps going up, that is a sign of inflation. Okay. Then the Federal Reserve will be forced to increase the rates. They can't keep it at zero because they're forcing the US government to raise rates through the 10-year yield, 15-year yield, 20-year yield, all these other bonds that they have. So, market commentators are going to talk about it. We're going to talk about it when that happens. But, when the yield goes up, that will be a problem for the stock market. Okay. So something to think about. And the other thing is we're hitting peak FOMO. I think you guys have heard FOMO, fear of missing out, multiple times. We are in a FOMO market, whether you like it or not. Okay. If you are not willing to be in a FOMO market, just stay away. Just keep the money under your pillow. That's okay. But if you want to make money, you have to play the game. That's it. That's how the current game is. I think you guys have seen the GameStop drama and the action in penny stocks like Sundial. It's crazy. SNDL was like what? Like a 10-cent stock? I know MSN is one of your favorites, right? A couple of months ago, what was it, like 15, 20 cents? I don't know. Now it is like what? It went up all the way to like $4. It's crazy. So there is a lot of FOMO going on, okay? And with social media and all, people are pumping stocks and all, but you can either say that this is a screwed up market, I don't want to play this game and stay on the sidelines. Fine. In that case, you have more time and you can enjoy your time. But if you're willing to take the risk and say that, okay, I'm going to play this game and I'm going to navigate this FOMO and figure out how to take advantage of it, hey, you're going to make a lot of money in this market. That's the way I look at it. I mean, I was just chatting with some friends, already in the last 6 weeks of this year, I made about a third of all the money that I made last year. So, just the momentum is picking up, it's getting crazy, but there is a lot of opportunity. So don't miss it if you want to. And then the trend is your friend. Again, we talked about that. So the price volume trend, momentum, that's still going on. So why mess with it? Don't go against the trend. Don't try to short this market. VIX is always reliable. Okay. UVXY remains a great forward-looking indicator for any pullbacks, like the late Jan pullback. So don't forget that. And there's a lot of social media influence. Okay. That was happening last year too, but I think it's getting even crazier now, right? We've seen Twitter pumps, Reddit pumps, Discord pumps. I mean, it's just nuts. But the key is, by being in a large chat group like ours, where we had 230, 240 people, we have all our eyes and brains looking at things. So when we notice something and we mention it, if it's not too late, you jump on it. If it's too late, then I'll short it. That's what I do, because I know it'll be a temporary spike. Okay. So there are ways to play these things any given day, because if it's not a fundamental pump, a fundamental reason why a stock is going up, some random guy is pumping it, or some newsletter is pumping it, 90% of the time I'm happy to short it, because I know that stock will come down. Okay. Of course, there will be outliers like GameStop, but I'm prepared for it. If I get trapped in a stock like GameStop, that's fine. I got to cut my losses and lick my chops and say, like, what, that's okay. I made money on 10 trades. I don't mind, losing money on one trade. It's okay. That's part of the game. You're not going to win them all. Okay. And then there are a lot of pay trades working. Pay trades, again, it's nothing new, but, I've been noticing a lot of them. For example, when Sava was moving, ABXL was moving. Okay. When GameStop was moving, AMC was moving, same thing. Express was moving, right? So these are all moving like, in a cohort. And the reason why this is important is, so for example, you have news in Sava, okay? Positive news or negative news. Sava will move first in whatever direction it's going to move, and then ABXL will follow it. So the advantage with the pairs trade is you can go after the pair, the second stock or a third stock or a fourth stock where you have a little bit more time to react, a few more seconds, maybe a couple of minutes, who knows. So that way, you still play the game, but it's like a derivative trade. You're playing through the pair trade. So that's why I like it. So, because the main stock, upon the news, it might go up and down, whatever, based on the news so quickly that you cannot chase it. So it is easier for me to play with the pair trade. Okay, so that's the reason it's important to watch those. And then small caps, 2021 is all about small caps. Like I said, biotech, Chinese names, Bitcoin related names, these are all acting crazy. They're just flying up or down, right? It all depends on what's going on. I mean, Bitcoin is like 50K now. It'll probably pull back now that there'll be some profit taking. So I'll be looking closely to short something like Riot or Mara, because they have run up very fast. You guys can see it went from 30 to 50 in 2 or 3 days. Okay, so there will be a pullback. It's like Newton's law. Gravity always pulls things down. Okay, it's not going to go up forever. So I am comfortable shorting Riot and Mara or whatever else, even MicroStrategy, MSTR, all these Bitcoin stocks. So I'll be looking for that on Tuesday. Next one is stock pickers market. Like I mentioned, don't let the market indexes fool you. This remains a stock pickers market. We have seen, right? Till date, if you look at 2021, the market index, like S&P 500, has moved up only like what? 0.5% or 1%. So if you're in indexes, you'll nothing's happening in this market. It's all the move is done. It's a dull market. But obviously that's not the case. Whoever is active, we know there's a lot of action. Okay, so there are 2 ways to play it. Don't be in an S&P 500 or a regular fund, but be in an ETF at least. If you prefer market ETFs like SPY and QQQ or IWM, they won't move much. So pick a sector ETF instead. MJNA, right? That is marijuana stocks, all the cannabis stocks. That's an ETF. JETS, that's the airlines ETF. TAN, that is the solar power, all the sun powers of the world, first solars of the world, that's that ETF. So if you are scared of playing in individual stocks, at least play the ETFs. You know which are the hot ones. You know which ones are going to keep going up because of Biden's policies. There's going to be a lot of money spent on clean energy. So that's going to keep going on. And then another thing is watch for sector rotations and trade accordingly. This is another key thing, money always rotates from one to another. It was in oil for a few days, it'll go to financials, it'll go to tech, you just have to keep an eye, watch those, read the market moves and, jump into that sector, into those market leaders in that sector, and you'll be fine. You'll catch like 3, 4, 5% moves easily. Okay. All right, let's look at some chat questions. I see that okay. What would be a good hedge? Honestly, right now, there is no good hedge. I have been without hedges for the last 4 months, I think, because it's an up market. Hedges basically like insurance you're paying for no good reason. When I know the Fed is going to take care of me, when I know the Congress is going to keep spending money, I'm not too worried. Okay, I will time the market. I will move my money from in my 401k to cash and then move back and forth after a small pullback. But in general, I don't have to hedge by buying tons of short ETFs or UVXY because it's not going to make money. Okay, so I don't think there's a really good hedge in this market, especially if you're a trader. There's no point hedging. Can you talk about the mechanics of tracking sector rotations? So the easiest way I track sector rotations is the CNBC website. Okay, so can you guys see my screen?
Yeah, we can.
So it's very simple. Go to cnbc.com/sectors. Okay. It gives you this sector map every day and it's real time. Okay. So let us see what happened on Friday, for example. Okay, so S&P broadly has these 11 sectors. Okay, 11 or 12, I don't remember. 11 sectors. Okay, so first one is consumer discretionary. Okay, this will be like all your retail, your clothing stores and food and beverage, all that kind of stuff. Consumer staples. This will be like your big conglomerates like Procter and Gamble, Hormel, all these big food companies, staples, right? Everybody needs these things. Energy, these are all oil and gas. Financials, the big banks. Health, usually your big insurance companies. Industrials, these are like the Caterpillars and GEs of the world. Materials, these are going to be like your miners and metal producers and all that, like FCX and all that. Real estate, you have all your malls and commercial real estate companies like Vornado and all that. Technology, no need to explain. Communication services, this will be like your Verizons of the world, Cisco's of the world. Then utilities, this will be like your electric companies, those kind of things, so let us see where the changes happen. Okay, so the biggest move was in energy. Okay, it went up 1.4%. So the money flowed into oil and gas. Okay, the next sector was banks. Okay, banks went up 1%. Materials, 1%. Okay, and now look at the sectors that went down. Real estate went down. Utilities went down. Okay, the rest of them are more or less flat. Technology went up a little bit, 0.5%. Technology, continues to go up, obviously. Okay, so this to me is a simple way to track. So, if you see a pattern in the beginning of the day or middle of the day, then you can say like, okay, you know what? There is a change. Okay, for example, you might see that energy is getting red, which means that money is flowing out of energy, and suddenly money is flowing into real estate. Okay, the red has become green. Then I would buy like a mall operator, like SPG, for example. Okay, like Simon's Property Group, right? So it just depends, so this is a very simple way for me to find out. I follow this, and of course, if you watch CNBC live, they talk about sector rotations and all too. Okay. How do you track the bond market? Is there a ticker I follow? Again, CNBC is a great resource. You just go to cnbc.com on your app or your browser, and you click on bonds. Okay. The key bonds are right here. The 10-year treasury rate. Okay. It is 1.21%. Which is not too bad, but if it goes over, like say 1.3%, people will start getting worried. Okay. And remember, this is a bond market, which is trillions and trillions of dollars. It is much bigger than the stock market. So even a 0.1% move in a bond market is pretty significant. And then you have the 10-year Bund. Bund is like the German bond. Okay. So what's going on in Germany? As you guys know, Europe has been, even negative rates for a long time. So look at that. Right now, the German 10-year is a negative 0.42, which means the government is going to give you money to borrow money. Isn't that crazy? Okay. Japan, almost zero. Okay. UK, 0.5%, little bit better than the rest of Europe. France, French 10-year, also negative yields. So now when you look at all the, big developed markets, isn't that interesting? The US seems to be more, stable. We at least have a positive interest rate, right? Germany, Japan, UK, France, all of them are like, much worse. So this kind of again goes back to why the US dollar is the world currency. There is a lot more trust in the world currency. Okay. Next thing, put options. Is there a better way to short so that there is no liquidation? Yeah, you're right. I mean, you can always do put options, and you don't have any interest rates. But remember, nothing is a free lunch. A put option is a time decay option. So if you are buying a put option for like say 2 months down the line, every week the value of your put is going to keep going down unless the stock is moving in the direction that you are betting on. I mean, there have been cases where, I'm sure you lost your put options, went to zero. So there is always risk. There is nothing called no risk. Okay. Next one is typical HDB stocks have no options. Yes. Yeah, they don't. You're right. Because they're just trading stocks. But some of them do. Okay. What's a good way to track sector rotations? I think we just talked about that also. All right. Hopefully we answered all those questions. So those are all my 2021 observations. We just have 15 minutes left since we want to keep this at about 2 hours. So let me talk about one for a few of the folks who are probably not, active traders on a day-to-day basis, So I just wanted to share what I have in my IRAs. Okay. The most recent editions are the top. My IRA, again, if you're not talking, can you please go on mute? Let me just mute everyone. All right, everybody's on mute now. Okay, so the easiest way to read them is, the recent ones are on the top. That's where I added money into my 401, IRAs, which is a little bit more long-term because, I'm not going to log into my IRA account every day. And I have a little bit higher conviction on their growth, so I don't mind, letting them run. So these are some of my favorite stocks that I've been playing a little bit more midterm. I never use the word long-term because that doesn't exist in my dictionary. Because I just can't just buy something and forget, that's not me. I have to monitor it and I have to calibrate and adjust it. So Facebook, everybody knows. As you guys notice here, I think it's an e-commerce play. I think Facebook is no longer an advertising play. I really think their next big move is going to be e-commerce, especially in WhatsApp. I think you guys all know they've been changing the privacy rules recently. And those of you who are familiar with WeChat, which is like the WhatsApp of China, they have completely changed a chat tool into an e-commerce tool. So I think Facebook desperately wants to do that with WhatsApp. And I think that will be a great thing for the stock. Of course, there will be some hiccups in the beginning. People will question about privacy and this and that. But, if they can do it well, where they actually make it convenient and take care of your privacy and not share information, I think they can do a good job. Next thing is Square. You guys know very well, it's a top financial tech company, fintech. It's been growing really well, especially during the pandemic, where everybody is moving to Square payments. Next one is AMD. I think no need to tell you about AMD. It's a new leader in the semiconductor industry. It's really kicking Intel's butt. AMD is like, really going at light speed compared to Intel. So that's going to continue. And then Inseego, this is my favorite 5G equipment play. I bought this a few months ago. I think around $10. I think it's like $15 now. First Solar, another favorite of mine. This is one of the very few all-American solar companies, because most of the solar companies, as you know, are Chinese. So I really like First Solar. The Walmart family is behind it. There are a lot of big investors, so they're a top company. So, but again, a lot of these companies, the stocks have run up so much that unfortunately it's probably too late to add any of these. Next one is Tdoc. This is my favorite telemedicine play. Earlier I had Livagno, LVNNG, but they merged with Tdoc. So Tdoc is my favorite. And this is also one of the favorites for ARK Investment, which is handled by Kathy Wood, as you guys know. Another favorite is Fastly. This is slightly speculative in my mind. They are a good company and they're growing very fast, but they don't have a lot of customer diversity. There are a lot of customer concentration in companies like TikTok, as you guys know. They were in the news last year. Next one, Lemonade. This is an insurance company. This is a new segment. They call it InsurTech. One of my favorites. I'm a personal customer of Lemonade. I think I've told many of you. If you have not used, download the app on your phone, and the chatbot is probably the best that I've seen. Very nice use of AI and automation. And the best part is their prices are, much lower than the competition. On my home insurance policy, my prices went down about 20%. So I'm pretty happy. So that's done very well. I bought it around 60. As you guys know, Lemonade is like 140 now. So that's a great one. Next one is GRWG. This is a cannabis farming equipment company. So this is a good long-term bet, I think. Another one is DKNG, which is DraftKings, which is online betting. I think all of you are familiar with that. Online betting is getting hotter and hotter, especially because more and more states are relaxing the rules, and it might relax even more with the Democrats, especially because they need the revenues. And online betting is like the easiest way, because if you give permits to build casinos and all, the voters are not going to be happy in all the places. But if it's online betting, nobody cares, and it brings revenue. So the states like that. Next one is Blink. This is EV charging, for electric vehicles. It's got the largest charging network, and they are great in PR, right? Every week they'll say, oh, we expanded here. Oh, we did this deal. We did this deal with this company, Stock keeps moving up, Of course, there have been pullbacks, but it's a pretty decent one for long term, I think, or at least midterm. Next one is Ozon. This is a Russian company, and, they've been touting this as the Amazon of Russia. Similarly, there's another one called Jumia that I think you guys are familiar, which is, they've been touting it as the Amazon of Africa. I think both of them have potential. I didn't add Jumia in my IRA, but I've traded it a lot, as you guys probably know. And then my latest edition was Fubo. This was about 2 months ago when it was around $30. So I took, about 1,000 shares, not much. And I took, I bought streaming sports. It's a little bit speculative, but it's getting harder and harder to find midterm, stocks. And to me, midterm means like, you want to hold it for at least a year. That is what in my book is midterm. Okay. So that's all I wanted to share, guys. Any questions before we wrap it up? I know it's almost 4 o'clock.
It's super useful, Suman. Thanks a lot. That's all I got to say.
Sure. You're welcome. I see that there's still 58 people, so,
Hey, Suman.
I guess it was useful.
Thank you, Suman.
Sure. Someone had a question?
Yeah, it's just personal. I know you mentioned you're a customer of Lemonade, right? So just wondering, do they offer insurance products to pretty much like on homes and automobiles, and are they limited?
You're talking about Lemonade?
Yeah.
Lemonade currently offers only 2 types of insurance. One is for homeowner insurance, and second is pet insurance. That's it. They are planning to get into life insurance market. That will be a huge segment. And because that they're already working on life insurance, the stock is already run up. But the moment they announce that they are going to offer term life insurance, I think the stock will move another $30-40.
Oh, thank you.
Yeah.
I think Root has auto insurance, right? Similar.
Root is only auto insurance. Root is different. Root doesn't have any of the others.
Yeah. One thing I want to add is with Lemonade, right? I heard this probably 2.5 years ago when I was doing the RPA stuff. So they have the app, which, if you home insurance, right? If you lose your jacket or so, if you send a picture of it, they will automatically use your AI to define a price. Say that, hey, this is whatever, Blueberry. So Blueberry, they will kind of do some scanning, find out what the price is, and they will make a decision on that right away, and they'll pay you. So the use case is it's a fastest payment using AI. So anyway, they're kind of pretty advanced in technology. That's all I want to say.
Yeah, it's pretty cool. And there are very few employees. There are only like 30 employees. So in terms of number of customers per employee compared to Geico, they're 3:1. So they're very, very efficient. So the model works very well, and it's very scalable. As they keep adding more customers, they'll be able to scale easier. And, And because of that, they do their own underwriting, in-house underwriting. So they're able to keep their prices low. So, they have a good story so far. I really like them.
Are they open in all through continental 50 states or only in
I
Texas?
don't know. You have to check. They will
Because
ask you a few questions. In Texas, they are available, obviously. That's how I was able to sign up. But
last time I think I checked about a year ago, they weren't offering in the state I live. So
I see. Which state are you in?
Georgia.
Georgia? Yeah. I can't tell you, I'm sure they keep working on it. And, insurance is a very, very, painful business, right? They have to go to each state commission and meet all the requirements. It's one-on-one, right? And it takes baby steps. Now, the other thing about Lemonade that I like is about 4 months ago, I think like October, November timeframe, I remember, and the founder stepped down, because founder was like a tech guy, right? He was very good with the whole AI part, the technology part and all. But he actually volunteered and told, you know what, the company is getting to the next level. We need to get an insurance veteran, because now it's not about technology. Now it's about how to get the access to new states, new markets, how to expand into new segments, like life insurance or auto insurance or whatever. You need real expertise and experience, right? So that to me was a very big, magnanimous move on the founders that, they identify the problem and they step down without any ego, because not everybody will do that. Of course, he's a smart guy. That's why he did it. He knows that if he wants to grow the company and make more money, that's the right way to do it. Let the best guys come and run it.
Yeah, that's typically is the path. Entrepreneurs should not be at the.
I know, but it doesn't happen all the time, right?
Yeah. I mean,
there are tons of companies where the founders ran the company, like especially in tech, it's very common, like Facebook and Twitter and Google and all this. The founders ran the companies till they were very big and mature.
Right.
So. Cool. All right, guys. Thanks for spending your afternoon on a Valentine's Day. Hope you guys have a nice evening today, and we'll get back into action on Tuesday.
Thank you so much.
All right, take care.
Thank you so much.
Thank you so much.
Bye.
Thank you. Bye.
Thank you.
Bye.
Thank you so much.
Bye.
Thank you, man. Bye.